Welcome back to the KJ Methods YouTube channel. Today we are on Finance Test Part 2. If you haven't been following along, you've missed a lot. So go back and look at all of the other playlists for the tests that we have already done. We've probably done over 200 questions so far. I'm KJ from the KJ Method. This channel is dedicated to getting 1,000 students to pass the real estate exam by the end of 2025. So you need to comment to me. Let me know, are these videos helping you? Don't forget to like, share, and subscribe to the channel. And also, as I stated before, these videos are not the only thing that's going to get you there. You need a really good study plan. Guess what? I've done it for you. All you have to do is click the link below and I will send you that free PDF where it will show you what are the most important topics, in what order you should study, as well as really good study and test taking skill tips. All right, so without further ado, let's get started with Finance Part 2. 11. Under the Truth in Lending Act, the law requires banks to disclose A. All fees that will be necessary to close the loan. B. The annual percentage rate of the loan. C. The right to rescind in all loan transactions. And D. The interest rate of the loan. This one should be really easy, but students have real difficulty with TILA and RESPA. TILA, what? Lending Act. It talks about the loan. That's how I want you to remember it. L for loan. However, the government requires that you or the bank disclose the annual percentage rate of this loan, not D, just the interest rate. The annual percentage rate takes into account all of, let me call them junk fees, right? All of the other things that the bank wants to charge you in order to get this loan, right? So you know you have interest. Let's say the interest is 7%, but then they're going to charge you some points. Then they're going to charge you an origination fee. They're going to charge you all of these other fees. So the government requires that they put all of those fees together and let you know. That is called the annual percentage rate of the loan, and it's often higher than D, the simple interest rate, because you know they're not going to just give it to you for 7%. They're going to charge you some fees too. So it's generally higher than the regular rate. Number 12. The purchaser of a home with a sales price of $500,000 is going to put $50,000 down on it and take a conventional loan for the difference. The purchaser will most likely have a monthly payment that will include A. Principal, taxes, insurance, title insurance. B. Principal, interest, taxes, title insurance, and mortgage insurance. C. Principal, taxes, and mortgage insurance. And D. Principal, interest, taxes, insurance, and mortgage insurance. Woo, that's a mouthful. Which one is it? It's going to be PITI, P-I-T-I. So D plus mortgage insurance. Why mortgage insurance? Because on a $500,000 house, they're only putting 10% down. And that means that the bank is going to require mortgage insurance on this loan also. And because they're only putting 10% down, they are going to make them escrow the taxes and insurance. So every time you make that payment to the bank every month, it's going to be principal, interest, which is the loan portion, then the taxes on the house, the insurance on the house, and the mortgage insurance, so you do not default on the loan. How did I know that? Because it is less than 20% down. When it's less than 20% down, all of those things are going to kick in. 13. The federal government has raised the discount rate again, resulting in higher mortgage loan rates. We learned that in number 1. John is a borrower. He still wants to buy a home, but he's hoping for a lower payment for at least the first 2 years, since he expects a huge raise on his job after a 2-year probationary period is over. What type of mortgage would John most likely benefit from? So we have to say, what is it asking us? So obviously he wants a lower payment at the beginning. All right. So let's look. A, an adjustable rate mortgage. B, an amortized mortgage. C, a graduated payment mortgage. And then D, a straight term mortgage. So would you agree that most likely he wants for 2 years, he wants a lower interest rate, and then he doesn't care that the interest rate goes up after 2 years. Lower interest rate is going to give him a lower payment. And so in that regard, the best for him would be an adjustable rate mortgage. Why? Because adjustable rate mortgages start with a lower interest rate and then they bump up and bump up and bump up, generally every 2 years or so. And so he is perfectly set to take an adjustable rate mortgage. Straight term mortgage is a lower payment, but what you want to remember about a straight term mortgage is it's a balloon payment at the end. He didn't say that he could pay this thing off. He just said that he needs some period of time to have a lower payment. So adjustable rate would work best in that. 14. The Equal Credit Opportunity Act, also known as ECOA, provides that the banks must treat people fairly when lending. It essentially follows fair housing, but it does add additional categories. So you know your fair housing categories, but it adds additional categories. What categories are added to the Equal Credit Opportunity Act? You should know this one. A, age, marital status, color. B, sexual preference, public assistance, color. C, sexual preference, age, and marital status. And then D is age, marital status, and public assistance. Now, guys, if you know your fair housing, it's already telling you it's additional from the fair housing. So you should be able to get rid of A and B pretty easily because color is a part of fair housing. So let's get rid of those. So now we're going to look at C and D. Is it sexual preference, age, and marital status? Or is it age, marital status, and public assistance? You've heard me say many times, sexual preference at this point does not get protection. So we know that it is going to be D. All this is saying is that if a person is older, even if they're 80 years old, they get ready to take a 30-year loan. Those numbers ain't working, right? But yes, it would be illegal for someone to discriminate against them. Marital status, all right, whether you're married, single, whatever, and public assistance. If a person is on public assistance, but they're going to be able to qualify with that public assistance, they can still get a loan. 15. The cost of the title insurance policy would most likely be included on what to document. A, tiller statement and good faith estimate. B, TRID loan estimate and TRID closing disclosure. C, equal credit opportunity statement and the HUD-1. Or D, the HUD-1 and the tiller statement. All right, title insurance. Title insurance is included in a RESPA statement. Settlement. I like to have students use the letters, right? So RESPA, RESPA, is the settlement cost, all right, which is all the cost to get this thing closed, whereas TILA, TILA, is just the loan cost, right? So it's just the cost relating to the loan. So title insurance comes under the settlement, this whole thing to get the loan closed. So if it comes under RESPA, then it would be the TRID loan estimate and the TRID closing disclosure. Why is that? Because the TRID is the combination, TILA, RESPA, integrated disclosure. It is the disclosure of everything. We have to tell everything at the beginning of the loan, and we have to tell everything right before it closes to make sure that these two statements match one another. If you are unfamiliar, I've done a video on the TRID statement, TILA and RESPA. Make sure you go take a look at that one, all right? So it will be the loan estimate and the closing disclosure. 16, the bank has issued a clear to close on Sally's home set for October 15th. The bank set an appraiser to the home on September 15th and the home appraised for the full price. That's great. Sally, however, never paid the appraiser and has decided to simply pay the appraiser at the closing. Is this permissible? A, no. although some parties can be paid at closing, an appraiser cannot. B, yes, as long as the appraiser performs service and his fee is included on the settlement statement. C, no, all parties must be paid prior to closing. And D, yes, as long as the appraiser agrees, the Truth in Lending Act allows it. Well, this is also RESPA. It says what can go on this settlement statement. The answer here would be B. As long as a person performed a service, right? We're not just handing out money to anybody, right? As long as they performed a service, they can be paid at closing as long as it's on the closing statement. 17, Sally is obtaining a loan from a lender. The stated interest rate on the loan is 5.5%, and Sally wants to lower the interest rate to 5%. So she should request what? A, that the lender allows her to pay more of a down payment to lower the interest rate. B, that the lender allows her to pay points on a monthly basis to lower the interest rate. C, that the lender allows her to pay points up front to lower the interest rate. And D, that the lender lower the interest rate to 5%. Yeah, can you just lower it for me? Right? The answer is going to be C, of course. You pay points up front in exchange for a lower interest rate over the life of the loan. So that one's pretty simple. 18, on an FHA loan, the buyer would not be required to A, provide mortgage insurance to protect the lender. B, meet all FHA funding requirements. D, find an approved lender willing to make the loan. D, make a 20% down payment on the loan. So which one would they not be required to do? A lot of times I get students that are confused by these questions, not and accept. All I say is not. If it's not, then you can easily go, they are expected to do that. They're not expected to do that. And that's how you come up with the answer. And so are they expected to get mortgage insurance? Yes. A is yes. Are they expected to meet the FHA requirements? Yes. Are they expected to find an approved lender? Yes. Are they expected to make a 20% down payment? No, they're not. So that has to be the answer. Real easy. Number 19. RESPA requires that all borrowers be informed of the potential settlement cost of the loan within how many days of application for the loan? This one should be easy. A, 1 day. B, 7 days. C, 3 days. D, no specified date requirement. Well, there is a date requirement, and it is 3 days. So within 3 days of the application, the person must be, all the settlement costs must be disclosed to that person under what we call a TRID statement or a loan estimate. 20. Private mortgage insurance would most likely be required in the following situation. A, borrower takes an FHA mortgage with a 3.5% down payment. B, borrower is purchasing a home where the appraisal exceeds the sales price. C, borrower takes a conventional loan with a 10% down payment. D, borrower takes a VA loan with a 0% down payment. Well, hopefully you got this. Private mortgage insurance, when it starts with private, we're talking conventional. That's the way that you know it. If it started with mortgage insurance premium, we're talking about FHA. All right, but private is going to be conventional. And so the answer here is going to be C. Borrower takes a conventional loan with 10% down. All right, so that's it on that one, finance test part 2. How did you do on that one? Let me know in the comments. Hey, I'm KJ from the KJ Method. Don't forget to like, share, and subscribe to the channel. Also, if you want that free study guide that I've prepared for you guys, don't forget to click the link and we'll get that right out to you. Until the next time when we're doing finance part 3. See you then.